Ladies and gentlemen, thank you for standing by. I am Geli, your Chorus Call operator. Welcome and thank you for joining the ElvalHalcor's conference call and live webcast to present and discuss the first half 2023 financial results. At this time, I would like to turn the conference over to Mr. Spyros Kokkolis, Chief Financial Officer. Mr. Kokkolis, you may now proceed.
Thank you, Geli. Good afternoon, everyone. Thank you for joining us for the presentation of the financial results for the first half of 2023. We will start with a short video about the company, and then I'm going to give you an overview of our performance, and after that, we will hold a Q&A session during which I will do my best to answer any questions you might have about our company and our financial performance. As usual, the presentation and Q&A will be later uploaded to our website. Let's start with a short corporate video. After our outstanding performance of 2022, we had a big challenge ahead of us: to try to match, as close as possible, the excellent results of that year. But it was obvious, even before the year started, that this would be a tough task. Inflationary pressures, rising interest rates, all this affected investments and consumer spending. Europe entered a technical recession. Demand softened gradually in most markets, or remained suppressed in segments where the effects were obvious, even right from the start of the second half of 2022. Now, under these conditions, our sales volume dropped slightly by 3.2% to 290,000 tons, even growing in key segments, and still well over the 2021 figures. Our adjusted EBITDA was 131 million euro, 18% lower than last year, but still 54% higher than 2021. Our net debt to adjusted EBITDA improved at 3.7 times, which is better by 0.6 times over the first half of 22. And our net debt decreased significantly at the level of 885 million, which is 163 million lower than last year. We reached another landmark during this year, which is the completion of installation of our new lacquering line, and this marked the end of a current major investment project in the aluminum segment. And this means that lower investments allows for our net debt to decrease. Working capital was also a very important factor in the decrease of net debt. And this reduction of net debt was on variable rate debt. Now, 54% of our debt is on a fixed rate, and this is helping us to mitigate any effects of the interest rates rising. Now, let's move into more detail into all the main factors that affected our company's performance and its development during the year. Many of you are already familiar with the standard pricing mechanisms in the non-ferrous industry. LME prices are fully passed on to the market. Sales and purchases are fully hedged. They create no cash flow effect from the fluctuations of the LME. But LME prices do affect working capital and do affect reported profitability due to accounting metal results which are generated by the method of valuation. In the beginning of the year, we saw both aluminum and copper price starting to recover. This recovery was short-lived, however. A slow but steady decline followed. This is a sign of the global situation and the lack of overall demand. Average prices, these were much lower than 2022, with no signs of recovering. This helped our working capital, of course, but also resulted in accounting metal losses. Let's look about natural gas. Natural gas was the positive surprise this year, declining steadily during the whole year and returning to more affordable levels. Still much higher levels than pre-pandemic. And the same thing happened with electricity. Both gas and electricity, there is more reasonable levels, more reasonable, yes, but still over 50% higher than what we once considered normal. During the period, we renegotiated our contract for our domestic plants with the PPC. Of course, at different market conditions and increased cost. Now, inflation had already started to decline, first in the US and then in Europe, but not as fast or as much as the central banks would like. Especially core inflation, it remains high, and the banks keep increasing the rates, and we see what happens today as well. As we have explained in the past, we are not primary metals producers, we are fabricators. We are not as energy intensive as primary producers. We use mainly natural gas in order to melt the metal and mainly electricity in order to process it. In terms of gigawatt hours, about 2/3 of our needs are covered by natural gas and the remainder 1/3 by electricity. Let's take a look at our 2023 cost breakdown and also compare it with 2022. Now, on this pie chart, we exclude the value of the metals, since we're passing them fully to the market, like aluminum, copper, zinc, etc. As you can see on the chart, energy was around 17% of our costs in the first half of 22. This was already very elevated from the 21 or prior year levels. Historically, it ranged to around 11 to 13% of our total costs. Now, it's clear from the chart that other types of expenses are more or equally as important. In 2023, electricity increased to 18%, which was exact same percentage for the full 22 year. In effect, the lower natural gas prices were countered by higher electricity prices. Inflation affected all other types of expenses, such as employee costs, and overall, there are some movements between the types of expenses, but nothing significant. No change in cost structure. The main drivers of our profitability are good volumes and good conversion prices. Turnover, which is affected by metals prices, is not a good guide as metal prices fluctuate significantly. Let's look at the next slide, the volume of sales evolution, and let me briefly remind you of how 2022 unfolded. Demand in the first half, in both segments, was overwhelming. We were struggling with capacity in order to meet demand. In the copper segment, the drop in demand started in the third quarter and continued in the fourth. Both of these quarters, they were better for the aluminum segment. We had increased our capacity and demand was holding much better. Now let's see how this year is evolving. Despite our increased capacity, growth has gradually faded in the aluminum segment. However, if we take out the effect of deconsolidating ATEM, sales volume grew by 1% in the whole period. Given the situation, we consider this an accomplishment. Our versatility and agility in both products and markets allowed us to counter the effect of the significant slowdown of demand in key markets. In the copper segment, we still face the same conditions like in the last 2 quarters of the month, lower demand, last 2 quarters of the last year, lower demand, which affected mostly brass rods and secondarily copper tubes, and on the other hand, continued strong demand for the products of our subsidiary Sofia Med, despite the market conditions. And there, we managed to increase productivity and volumes, and mitigating the drop. Let's see now one of the most important metrics of our profitability, which is adjusted EBITDA, and how it developed during the year. Again, let's remember what happened in 2022. The aluminum segment had impressive figures of growth, more than doubling their adjusted EBITDA in the first 3 quarters. On the other hand, the copper segment had more modest growth in the first and second quarters, modest but still good growth. And let's see 23 now. We see that this year, in the aluminum segment and in both quarters, profitability is down from 22, but it's still higher than 2021. Now, prices remained at good levels. Volumes did not drop. What turned to the worst? The answer to that, electricity prices and inflation, these affected our costs, and also the spreads of scrap. Due to the low global demand for aluminum, premiums for primary aluminum fell, and this affected the profitability of recycling. Now, on the copper segment, we see a much different story. Despite lower volumes, profitability grew. We managed to contain cost and optimize production where we lost volume, and also the extra quantities from Sofia Med were of high value-added products at better electricity cost, since Sofia Med did not enjoy our previous domestic electricity contract. One way now to measure our profitability and be able to extrapolate volume into profitability is to look into our adjusted EBITDA per ton. Looking first at the aluminum segment, in the prior years, we were looking at an adjusted EBITDA per ton of around 300 euro. The market conditions allowed us to double that to around 600 euro per ton in 2022. And now let me quote myself and what I said in the full year results presentation. Under current conditions, it's possibly not sustainable. However, we do expect higher levels than the average of 300 euro of the last years, and this is definitely our target. Let's see how we did. And this is exactly what we have achieved, a level of 386 euro per ton. On the other hand, in the copper segment, where the growth was not so prominent for 2022, it continued and even accelerated in 23. And this is a result of our consistent strategy with the development of our subsidiary, which has paid off. Another important metric is the industrial value added per ton. This is the price that we actually charge over our cost of metal, and so it incorporates conversion prices, transportation and other costs charged to the customer, and also our ability to transform scrap into metal and thereby increase our value added. Both segments managed to successfully increase prices in 2022. But in 2023, the industrial value added of aluminum dropped slightly. It was not conversion prices that affected this, rather it was the scrap spreads that I mentioned before that reduced the benefit from recycling, and also increased cost, reduced profit per tons that we saw in the previous slide. Scrap spreads on the copper segment, on the other hand, increased slightly. Recycling benefit increased. Conversion prices remain strong, and the continuous shift to high value-added products of Sofia Med is helping significantly. Let's see the distribution now of sales by market. And looking into the revenue breakdown by market, we see that we continue to increase our sales in the aluminum segment towards the packaging sector in 2023. This was the main target of our investments. This is a segment that's especially affected by the macro trends, and now takes up 59% of our sales. However, even this segment was affected by the slowdown. As a result of inflation, consumer disposable income fell, spending fell, and actually we did not reach our targets in sales. Also, the share of construction has shrunk even further, as you can see on the chart. This is partly due to the consolidation of ETEM, and all other segments remained at similar levels. In the copper segment, the building and construction segment was the second biggest market. Now it's dropping to third. It's at the same levels as heating, ventilation, and air conditioning. On the other hand, industrial applications, automotive, power and energy are continuing to increase their share in the pie. Let's now see the geographical distributions of our sales. Both segments are heavily export-oriented, with Greece being a small part of aluminum sales, which is shrinking gradually as sales increase, and a very small part of copper sales. Most of our sales, you can see, were in Europe this year as well. The UK shrunk slightly in both segments, and the US has shrunk a bit in 23 in the aluminum segment. There was a temporary disruption of sales in the US this spring. This was due to the presidential proclamations regarding the aluminum tariffs on Russia. We had to ensure that our sales to the US fully comply with them. We did that, and then we resumed sales, and they pick up to the usual levels. Now, let's move on to the consolidated key figures slide. We have seen in detail the evolution of our volumes and adjusted EBITDA. Looking at the consolidated figures for the period, they were both higher than 21, but at lower levels than 22. As metal prices were lower, the effect on the revenue on turnover was higher. Now, as we said, this year we had metal losses, the effect of declining metal prices. On the previous year, metals were rising and we had metal profits. This is an accounting, it's not a cash effect, and this is the reason that we always focus more on our adjusted figures. As a result of the metal losses, EBITDA dropped even further to 101 million euro. EBIT. This was also affected by the metal losses. So we look at adjusted EBIT, which was at 93 million euro, lower than 22, but still higher than 21. Rising interest rates. This hit our financial result, and finance cost increased by 43%, despite the drop in net debt and despite the big part that's on fixed rates. And of course, this affected the earnings before tax even further. Now, we do not report our adjusted earnings before tax separately, but one can easily do the calculation and calculate the effect of the metal result there as well, and see how that affected. Let's look now at the deviation analysis of our profitability. Volume played a very small part on overall profitability. On the price, cost, mix side, we have already gone through the factors, and let me recap. Lower difference between scrap discounts and primary premiums, and this reduced the benefit of recycling. Increased cost, mainly because of electricity and inflation, and partially better mix and price. These are the factors that had the biggest effect. On the SG&A, inflation took its bite. Now, on the financial, rising interest rates affected financial costs, and of course, the difference in metal result, turning from profits to losses, had the biggest impact. And moving on to the cash flows, we had strong profitability this year. EBITDA was a bit over 100 million. Of course, we had to pay our financial costs, and then working capital, which we will see the details in the next slide, improved significantly. And this released 90 million for the period. Investments, this slowed down, and all this allowed us to repay loans, and of course, paying the dividend, which was double than the previous years, and even leaving us with more cash than the beginning of the year. Now, working capital is very important, and let's see how we did. There we can see steady improvement. And we can see it both as in percentage of sales, but also as an absolute figure, and especially over the mid-year of 2022. It has improved by 211 million. Of course, as we said last year, part of the working capital in the mid of last year was temporary. This was around 40 million of extra inventory for the upgrade of our copper extrusion press. But the rest of the difference is actual. Low metal prices helped, but we improved the working capital even more than that. Evidence of that is that we have a decrease as a percentage of sales. Good cash flows allowed us to decrease our debt and meet our target of keeping our net debt to adjusted EBITDA at almost the same levels as at year end, at 3.7, as you can see from the bottom right chart. Let's move on to debt now. As we said before, we managed to decrease debt, and the proportion that's on a fixed rate increased to 54% of the total debt, while it was 48% at the end of the year. Most of our debt, you can see that it remains long-term, and of the short-term, most of it is long-term maturing within 12 months. I believe we're well positioned in order to meet the challenges. Last but not least, capital expenditure. As we have already mentioned, investments have slowed down, especially in the aluminum segment, where all major investment projects are now complete. We have slightly accelerated our investments in the copper segment, and in particular in Sofia Med, in order to release more capacity in high value-added products. This period, we spent something over 50 million. Our target was not to exceed 100 million for the full year, and still is. This concludes my presentation, and we'll now have the Q&A session.
Mr. Kokkolis, there are no audio questions at this time. If you would like to proceed with any written questions, thank you.
I have a double question for Ms. Maria Karagiannaki regarding the aluminum sector. If the lower industrial value added drop is common across products of all markets, or is it just in the packaging sector? No, it's not talking about the drop. Is there a strategy in place to move into more profitable markets than packaging, transportation, renewables, HVAC and R? Okay, let me answer this question. The packaging sector, yes, it's not the most profitable as in terms of industrial value added, but there are more things than profitability per ton. It's also one of the most able to increase markets, so has the largest growth potential. Also, there are other markets which are more profitable. Yes, we always take advantage of these more profitable markets because we are very flexible and we manage to sell to all markets that have high profitability. Especially when other markets drop. And this is one of the ways that this year we managed to not lose a lot of industrial value added in the aluminum segment. Our general strategy is to grow on the packaging, but also we always grow on other segments as well. We do not get out of the other segments, and we always try to enter more profitable market segments, which are smaller, of course, and do not maybe have such a huge growth potential. On HVAC and R, this is mainly got to do with copper and not aluminum. Of course, it's a smaller part of aluminum. This is one of the segments that copper is expecting to have a big increase in demand and sales.
Thank you, Mr. Kokkolis.
I see no further questions in the web. So I would like to thank everyone for following this presentation. And we hope to have you again in our next session with us. Thank you.